All right. Thank you, Aaron. Uh, I'm glad you mentioned something about financing because that's what last week in-service training, I was telling people, we need to be sharing with producers, even in the good times in the cattle industry, we need to be talking to our lenders. And, and I would also encourage a lot of these farmers to be talking to their landlords, because I noticed that $200 an acre rent, and in the current price environment for crops, that doesn't make a whole lot of sense. So, open communication in good and bad times is really important. Um, so I just some thoughts there. Um, I guess from the cattle standpoint, uh, Aaron mentioned that I wrote that Argentinian beef piece before we got started, and I hope that was of use. And I'm willing to discuss that if somebody has questions on that. We discussed it in the western and central regions of in-service last week, and I put together the piece because people were asking questions. There's not a whole lot of fresh data to look at uh, just because of the government shutdown. So we're going to touch on a couple of those things. And then we might talk about Argentina and maybe some of this Department of Justice looking into uh, the Packers and thinking that whatever President Trump has got going on there. Um, just throwing this up there immediately for finished cattle prices. We've come off our record highs. They have certainly softened quite a bit, and the futures market has finished cattle trading lower over the next 18 months. So looking all the way into the summer of 2027, I mean, we're not even into 26 yet, so it's hard to say 2027, but we're looking at finished cattle prices about 15, $20 lower than they are today into the summer of 2027. So just month by month by month, we see lower and lower prices. I don't know that the fundamentals would support that. I think there's a lot of rhetoric out there right now that is encouraging a negative tone to the cattle industry. Uh, in a time period when the fundamentals say that cattle producers should be enjoying some good times, and I realize crop producers are in a little bit of a struggle. Um, but somehow or another, our government has found a way to put a damper on the cattle industry at the same time. Um, how that plays out, we don't know yet, but realize that this time of year, typically we start to see live cattle prices gain a little bit of steam as we head towards the holidays. And right now, we're out of steam. So I don't know what to expect there. Trying to produce an outlook of what those prices are going to be in the next quarter or so. I'll provide that, but I don't know that we have a great idea because of the tremendous amount of uncertainty. Oddly enough, despite how bad futures for feeder cattle have declined, uh, these 5 to 6 weight calf prices, these freshly weaned prices, are much stronger than I would have expected, given uh, what feeder cattle futures have done, because we have seen several loads of cattle sold that are true yearling cattle, and those prices have softened considerably. I saw several that were no sold last Friday. Several loads that were no sold, and I guess some of those people are just going to put those in the feedlot themselves, based off discussions with those producers, and see if the market will turn around over the next 5 or 6 months. because essentially that's where that's how long we're keeping cattle on feed is about 6 months. I think the latest Kansas state data was like 183, 187 days, something like that, which is down a little bit because we were closer to 200 days. Um, but when you come in through the summer months, uh, you typically have better gains. So those cattle are reaching 1,500, 1,550 pounds a lot quicker, just more efficient during the warm months than they are during the cold months. So I have a feeling we'll start to see days on feed increase again as we go into the winter and move through the winter. We'll start seeing 200 days on feed once again, especially with this cheap feed that we currently have. But producers are still selling these lightweight calves well over $2,000 a head. It's still really good times, regardless if we're off the highs. You know, we nearly hit $4 on these 550-pound steers, just shy of it. Now we're probably sitting around 377, 378, something like that. Really strong prices, lot of money flowing. Has tax implications that will probably people have to be thinking about. This is where you see these true yearling cattle prices really tanking. Now, this is a weekly auction market price, but we saw this same thing happen with our load lots for 8 weights, 9 weights. Uh, it's just getting pretty tough. And so I guess for those of you who have stocker operators, this is really going to tighten margins because of what they're still having to pay for those calves that are coming straight out of the sale barn, high risk cattle. And I would expect that at some point somebody's going to have to start paying a little less for those lightweight calves because there's just too much risk for the small profit margin that's available given what the futures market has done the past few weeks. The one market that is still really strong, and this is where we can talk about Argentina. Slaughter cow prices are still strong because there is a very much a need for lean grinding beef. When the president talked about reducing beef prices, number one, we know he can't do it. You can't just reduce beef prices because you say something. He has effectively reduced cattle prices, though, with his comments. And thus, the cattle producer is challenged with that. But he can't make Kroger and Walmart and Piggly Wiggly and Albertsons and whoever else is out there, he can't make them reduce their beef prices. And the consumer has proven that they demand beef and they want beef, and so they're willing to pay for beef. And I've read some articles that said that consumers, they're paying more for beef, they're just buying less of it. Well, simple economics, it's not even economics. When you produce less of something, people have to consume less of that product because there is less of it available. So it is not rocket science, brain surgery, or any other. It's very simple. Yes, consumers are going to consume less beef because there's less product available. Higher price, of course. The reason for higher prices is to ration the quantity we have available. So we would expect people to purchase less with a higher price, but yet inevitably we still continue to see, because demand is a function of both price and quantity, demand for beef remains extremely strong. So I don't know. I don't want y'all to get caught up when you're reading articles or you have producers come into your offices that say, oh, this article says so-and-so. Well, stop a second and think through it because it's very basic. But it just kind of, some of this propaganda writing has kind of enhanced the rhetoric from our Oval Office, I guess. So be cautious there. But what the particular price that President Trump could talk about is ground beef prices. It's one of the most versatile products we have, and these slaughter cow prices have remained strong since May, June time period. I mean, just astronomically high because we have a need for lean grinding beef. And the one thing is when we're finishing cattle at 1,500 pounds or heavier, we're producing a lot of fat in our finished cattle market. Well, what do we need to go with that fat? Lean grinding beef. That's going to come from our slaughter cows. There is some in those trimmings from those finished cattle, but the other primary source is going to be imports. And so we need those imports because it actually increases the value of the finished cattle that we're producing because now we have a higher value for the fat that we're producing. I know that may seem a little counterintuitive to some, but if you just think through the basics of it, what value does fat have in and of itself? Very little. I mean, there's a value for it, but once you can mix it with a lean beef and get your 85-15, your 80-20, your 93-7, whatever it is, lean to fat ratio, you add so much more value to that fat. And you're also adding a lot of value to that lean beef that you bought fairly inexpensively from another country. So those are things that add value to what we're already doing here today, which should support cattle prices. But as I said, the statements and the rhetoric that's been talked about have effectively reduced cattle prices and have done nothing to beef prices. There's not a whole lot to say about slaughter and beef production, total beef production. There's just not a whole lot to say there because we haven't had any data since the end of September. I'm not going to say it's not recorded. I'm going to say that we don't have data available to us because of the shutdown. So if we happen to get the government reopened, will they backfill that data? I don't know. If history is a precedent, we can go back several years and see that those data points were not filled. And so we may not have any information here moving forward. We'll have to just wait until the government reopens and see how that plays out. Data may not be filled, but I guarantee you that they'll give back pay for the people that aren't working right now. So I don't know. But at the point we've got all these up to the end of September, heifer and steer slaughter down nearly 5% and beef cow slaughter down nearly 18%. But beef production down slightly. And the reason why beef production is only down 3.5% relative to the 4 to 5% reduction in slaughter is because we're growing these animals so large. We finally started to see some increase in broiler production. I expect that to continue ramping up with these high meat prices. Again, not much information from the international trade standpoint. These imports are going to continue to increase. Going back to the Argentinian thing, this is the article, the one burger effect article that I sent out last week. Just to reiterate it, going from 20,000 metric tons to 80,000 metric tons of beef from Argentina. That is 0.38, 0.39 pounds of beef that each consumer in this country would have to eat. So one or two hamburgers and we wipe that out. And I don't think anybody has much trouble eating an extra one or two hamburgers in the current environment that we're in. Now, I firmly believe there's something bigger at play here because if our president really intended to reduce ground beef prices to some degree, then Brazil is the natural player to pull lean beef from. But instead, he has decided to continue to increase tariff rates on Brazil instead of relaxing those tariff rates. And they're 76% or something. So whatever, it's something close to that. So if your intention is to reduce beef prices for your domestic consumer, and then you increase tariff rates to the country that actually has a significant quantity of beef that we could import, then I think he has something else in mind other than beef prices for our domestic consumer. There's something at play. I don't know what he wants out of Brazil, but I think there's something there. No reason to speculate, but my common sense looking into this says this isn't really about beef prices. This is about something else. And so he's trying to achieve whatever that objective is. Backing up to exports, we've been seeing exports continue to decline. That's normal too. When you have less product and it's at a higher price, you're not going to export as much. Same reason why we're importing more, because we have really high beef prices. We're not producing as much domestically, so it's cheap to buy beef from somewhere else. That's what we're doing. Now we do have cattle prices and boxed beef prices are up to date. And so we do have boxed beef prices. Let me speak to this whole Department of Justice, and we need to look into collusion between the four major packers. The four major packers being JBS, Cargill, Tyson, and National. So JBS being Brazilian owned, National is also Brazilian owned. Marfridge, I'm pretty sure it's Marfridge that owns that. And then the other two being domestically owned. Those four packers account for 80 to 85% of the market share for finished cattle. 80 to 85%, somewhere in that range. I don't know the exact. So those four major packers have that much market share. Now, here's my thought process on this, and to support what I'm fixing to say. So our president has ordered that the Department of Justice look into collusion and price fixing from these four packers, and that's why beef prices, retail beef prices, are so high, because they've done something that is not good. It's that why would packers, if they could do this, why would they be losing money in the current environment, and we're talking about hundreds of dollars a head? Why would they do that if they could actually control what they sell beef prices for, or sell beef for, and what they pay for cattle? If they truly had control, why would they be losing millions of dollars in the current environment? Does not make sense to me. Maybe if you're trying to cover it up, you might have a short time period where you lose a few dollars a head, and then you come back and then you start making good money again. Then you might lose a few dollars a head. It doesn't make sense to me that these four packers have colluded, because they still all act independently. They want to make as much money as they can for themselves. If you can overlook that. If you don't agree with that argument, that's fine. We'll move on. Going back to ground beef prices, those same four packers only control maybe 30 to 35% of the ground beef market, because a lot of our ground beef is coming for our non-fed market, I should say. So our cull cows, our cull bulls, all those things that are going into ground beef, they only control 30 to 35% of that market, because we have a lot of these smaller independent facilities that are killing slaughter cows and slaughter bulls. At the same time, we have, same reason why Walmart probably has invested heavily in the finished cattle market in their agreement. Somebody, I think it was in the central region, said that they saw prime beef in Walmart. Well, probably the reason for prime beef in Walmart is because now, since they have ownership in a slaughter facility, or an agreement with a slaughter facility, that slaughter facility is probably producing 8 to 10% prime beef, and it has to do something with it. And so it's going through the outlet that who they have an agreement with. Um, and so this whole issue, if you have producers coming in your office saying, wondering if this is a concern and thinking that, oh my goodness, these packers are getting us, I really don't think that's the case. And I'm not here trying to defend them by any stretch of the imagination. I'm just trying to use some logic and some common sense to evaluate what's going on. Aaron showed that vegetative index. If we looked at this same drought monitor a few weeks ago, it was even more widespread than it is right now. The problem is recent moisture is not going to result in much forage growth. So I think I'm using this as my argument for the reason why I don't think there's going to be tremendous heifer retention in 2025, because we really have one time period to retain heifers, and that's at weaning. And that's typically in the fall. And I would say a lot of these producers have been selling a lot of their heifers. I've actually talked to some order buyers that have said they have seen large quantities of high quality heifers going through the market, which would tell me that we're really not retaining a whole lot of these heifers. So that's kind of anecdotal, but at the same time, we're talking about people that spend their days in sale barns all year round, and they're still seeing a really large quantity of high quality heifers that would probably be replacement quality, but they're going to the feedlots because most people aren't going to have the feed resources to keep up with them. Aaron's already talked about corn prices briefly, but corn is cheap. Corn's cheap. It would be a good supplement, cheap supplement for cattle that are deficient in energy. Would change rumen microbes, certainly. So from a nutritional standpoint, you might want to think, producers need to think from the nutritional standpoint as well, not just a economic price standpoint. But there would be a lot of cheap energy in corn right now if cattle or the cow herd or some type of stocker or backgrounding program needed that. Due to those low corn prices, we're essentially growing these cattle a little under $1.05 a pound cost of gain in the feedlot. That's extremely cheap, and it's some of the cheapest that we've seen in a long time. And I suspect it's going to remain that way. I just don't see that corn prices are going to escalate a lot in the near term. Talking about retention, we need to see the percent of heifers as a total percent of heifers on feed as the total percent of cattle on feed. What this graph's saying, it's a quarterly number, is that essentially 38% of the cattle on feed are heifers. Well, we need to see this number closer to that 34, 30, somewhere between 32 and 34 for us to really say that we're retaining heifers to rebuild the cattle herd. Because we would expect 50% of the animals to be heifers and 50% of them to be bulls as born. And given that we're sitting around 38% of total cattle on feed being heifers, that would say that we're really not retaining enough to even replace the cows that we're killing at that great of a extent. This is the November feeder cattle futures price. We are currently $43 or so below the apex of this market. I don't think that's a fair thing to say, just because an apex is the highest point, and we shouldn't always be looking at the highest point. But we did decline about $60 at one point, and we've recovered a few of those dollars. Where we're going to settle, I don't know. It looks like it's going to be tough to beat the 350 mark. But as I said earlier, if we look at feeder cattle futures over the next 12 months, I guess I discussed live cattle, but as we look at feeder cattle futures over the next 12 months, if I'm not mistaken, mistaken, the November 2026 is 30 something, 309, 307. So essentially $30 lower than where we are today for next November. And each month, as we move from this November to next November, has feeder cattle at a lower price than they were the month prior. So that's very important. I don't, it's hard for me to believe, for instance, that August feeder cattle are going to be lower than May feeder cattle of 2026. That's really tough for me to believe because late summer tends to be when we have the strongest prices for those feeder cattle. So if any type of seasonality takes place, we would expect August to be higher than May. But right now, that's not what the futures market is calling for. I think this is the August. Yes, it is. And you see where we're $20 below November. So if futures traders have anything correct, they're saying we're going to decline $20 between now and next August. Those are still really, really high prices, but fundamentals, if fundamentals rule the day, then I don't expect that to be the case of a $20 decline from today. We'll just have to see how that plays out. The last two slides, I've reduced my fed cattle price forecast quite a bit. I'm not as negative as the futures market because I don't think that's the truth. So I'm contrary to the futures market here, as well as I am contrary to the futures market for moving through the next 6 months or so. So with that, I will stop sharing.